Have you ever wondered why some people seem to get richer over time, even while they're sleeping? It's not always because they earn more money. Sometimes it's because their money is working for them. And that's where investing comes in. But here's the problem. If you've never invested before, words like stocks, bonds, ETFs, mutual funds, and market risk can sound incredibly confusing. So in this video, I'm going to break investing down from the ground up in simple language. You'll learn what investing actually means, where beginners can invest, how risk and return work, and what you should do before putting your first dollar into the market. Let's get started. First, what exactly is investing? Investing simply means putting your money into something with the goal of making it grow over time. For example, imagine you have $1,000. You could leave that money sitting in a bank account. Or, depending on your goals and risk tolerance, you could invest some of it in assets such as stocks, bonds, or diversified funds. The goal is simple. Instead of your money just sitting there, you're giving it an opportunity to grow. But there's something every beginner needs to understand. Investing is not the same as saving. Saving is mainly about keeping your money safe and accessible for things you may need soon. Investing is about growing your money over a longer period of time. And because you're trying to earn a return, there's also risk involved. That's why you shouldn't rush into investing before building a basic financial foundation. Before investing, make sure you have some emergency savings. Think about it this way. If you invest every dollar you have, and then your car breaks down or you suddenly lose your income, you may be forced to sell your investments at the worst possible time. That's why an emergency fund is so important. A common goal is to have several months of essential expenses saved in an easily accessible account. And if you have high-interest debt, especially expensive credit card debt, you may want to deal with that before aggressively investing. Because there's little point chasing investment returns while high-interest debt is constantly working against you. Once your financial foundation is stronger, then you can start thinking about investing. So, where can you actually invest your money? Before we talk about buying investments, let's quickly understand some of the most common ones. First, what is a stock? A stock is a small piece of ownership in a company. For example, imagine you own one tiny piece of a company like Apple. If the company grows and becomes more valuable, the value of your stock could increase. But if the company performs poorly, the value of your stock could fall. That's why stocks can offer growth potential, but they also come with risk. Now, what is a bond? A bond is different when you buy a bond. You're essentially lending your money to a government or a company. In return, the borrower generally agrees to pay you interest and return your principal according to the terms of the bond. Think of it like this. A stock means you're becoming a small owner. A bond means you're becoming a lender. That's the simplest way to remember the difference. Another popular investment option is an ETF, or exchange-traded fund. An ETF is a fund that can hold many different investments inside it. For example, instead of buying stocks from dozens of different companies individually, you could buy one diversified ETF that holds many companies. This can make diversification much easier. And then there are mutual funds, real estate, and other types of investments. The important thing is that you don't need to invest in everything. You need to understand what you're investing in, why you're investing, and what risks you're taking. Now let's talk about one of the most important ideas in investing, risk and return. Generally, investments with higher potential returns also come with higher risk. A savings account may offer relatively low returns, but your money is usually much more stable. Stocks can potentially produce higher long-term returns, but their prices can also fall significantly. And some investments, like individual stocks, options, or cryptocurrencies, can be extremely volatile. That's why you should never invest money simply because someone online promises you'll make huge returns. If someone tells you an investment is guaranteed to make you 20, 30, or 40% every year, be very careful. There are no guaranteed high returns without risk. And remember, a temporary drop in the market doesn't automatically mean you've made a permanent loss. But if you panic and sell at the wrong time, you can turn a temporary decline into a real loss. That's one reason long-term thinking is so important. So, how should a beginner actually approach investing? First, don't try to get rich quickly. Investing is not a lottery ticket. It's a long-term process. Second, don't put all your money into one investment. This is called diversification. If one company or one asset performs badly, diversification can help reduce the impact on your overall portfolio. Third, invest according to your goals and your risk tolerance. Money you'll need in a few months shouldn't usually be treated the same way as money you're investing for retirement decades from now. And fourth, learn before you invest. You don't need to become a Wall Street expert, but you should understand what you're buying, what could make it go up, what could make it go down, and how much you could potentially lose. Now, what are the benefits of investing? Over a long period of time, investing gives your money the opportunity to grow. And one of the most powerful concepts is compound growth. That's when your investment returns can generate additional returns over time. The longer you stay invested, the more time your money has to potentially compound. But remember, investing also has real risks. Your investments can lose value, markets can crash, individual companies can fail, and even diversified investments can experience significant declines. That's why you should never invest money you can't afford to leave invested or potentially lose. The goal isn't to find the investment that makes you rich overnight. The goal is to build a strategy you can stick with for years. So if you're completely new to investing, start with the basics. Build your emergency fund, understand your debt, learn about different investment options, choose a level of risk you can actually handle, and think long-term. Because successful investing isn't about predicting what the market will do tomorrow. It's about making smart decisions consistently over time. If this video helped you understand investing a little better, make sure to like this video and subscribe to Your Financial for more simple, practical personal finance videos. And if you want to learn more about managing your money, check out the other videos on the channel. Thanks for watching, and I'll see you in the next video.